Good morning everybody, I'm Sarah Irons. I am a commercial finance broker and today I am bringing you a video on self-build. I have been lucky enough to be working with some of the people from the Grand Design Show for a few years now, so I do get involved with a lot of self-build mortgages. I wanted to keep this video quite brief. I did want to explain the difference between a self-build mortgage and a regulated development finance loan. So self-build is basically based on your income. It's like a normal mortgage, it's assessed on your income, and based on that you will have a loan size which is typically a similar affordability as a residential normal mortgage. So 4.5 times income, that isn't a set amount, they do use affordability. I would say they might be slightly more flexible than a residential mortgage lender. For example, if you are renting and you've sold a property and you're using that money to embark on your self-build, they will potentially disregard the rental payment each month when it comes to affordability if you have sort of a lump sum in the bank from your sale, for example, or savings set aside for it. So things like that, they can be a bit more flexible. But on the whole, they are using your income to assess the loan size. If that is enough for your self-build, then fantastic. They will give you a loan on a rate that is a little bit higher than residential mortgage rates, but very similar. And they will give you this money in stages in arrears. So much like normal development, you fund the first stage and then they will send out a quality surveyor or asset manager who will assess the work that you've done, confirm back to the lender that you have spent the money on the project, and they will release the next stage to reimburse you. They will be also assessing their loan to value based on the end value of your property, and that is called gross development value. We call it GDV, which just stands for gross development value. So once your property is built, that will be the value at the end, which will be much higher than it is at the start. They will look at the start value, they will look at your build cost, and they will look at your GDV. And if that all fits within their parameters of their criteria when it comes to loan to value, for example, and minimum loan sizes, then they will lend. And that is basically how a self-build works. It will be monitored along the way. Normally you are inexperienced with a self-build, so you've not done this before, so it's very normal to see a building contractor in place. They will want a warranty. Sometimes you will have an architect's warranty, which is a 6-year guarantee, and sometimes you will have a more official sort of 10-year house warranty. Most are fine. One thing I will say with a self-build, especially nowadays, we are seeing a lot of eco builds, which is fantastic for the environment. However, some lenders haven't really caught up on this, so be very careful with the construction of your build. Make sure that you can actually get out of the self-build loan. I'm sure at the end of it you may want to refinance onto a residential mortgage with a lower rate, lower loan to value, for example. So be careful, because we do find that architects draw these beautiful homes, and these homes are built and they look absolutely wonderful and beautiful. However, for example, if you have 100% cladding, 100% wooden cladding, so that's different to the sort of regulated cladding that you're hearing about on the news. So 100% wooden clad stuck to a wooden frame, for example, or timber frame, I should say, is very difficult to get a lender for, very difficult. And we have found that we actually just can't get a lender for people. And you know, it's a shame that we've been introduced to them once that property's been built, so we won't be able to give them that advice or get them to speak to their architect about that at the front end. But yeah, that is something that I'm working on with one of the Grand Designs experts at the moment. We were the mortgage experts at the Grand Design Show in London a fair few years ago now, and we've kept our relationship with them and we do a lot of work with them. So yeah, modern method of construction, or MMC, is something that we see so much when it comes to self-build. Often cheaper to build and quicker to build, but please do check that you can actually get another mortgage with another lender after your build is complete. We have older clients that do self-build with an intention of changing to a lifetime mortgage afterwards. Again, these lenders are very much standard construction, so please do your research or speak to a broker before you embark to make sure that you can exit your self-build. Apart from that, I think that's all the detail I wanted to give on this. It's just something that does keep coming up, so if this is a pre-warning for anybody out there that is doing their self-build or about to embark, speak to a broker first. There are a few self-build lenders out there now, all with different criteria, which obviously your broker will be able to research for you, saving you time, money and credit checks at the outset. And yeah, there's lots of different ways to do it, lots of different construction. So yeah, it's definitely a minefield. So make sure you get advice, and hopefully that will carry you through and see your project complete and you be happy at the outcome. So what is the difference then between a self-build mortgage and a regulated development finance loan? So development finance is very typically unregulated. So it might be somebody building a second home in a garden, a second house, sorry, in a garden, or a block of flats or 10 houses on a site. So development finance on its own is normally unregulated. Regulated development finance is home. So when regulated is used, it means it's a home, it was a home, it's going to be a home, there's an intention to live in it, makes it a regulated contract. So the difference between self-build and a regulated development finance is self-build is based on income and regulated development finance is not. However, they will be looking into the exit of the loan, i.e. how are you going to repay the loan. So it will factor in, but it's not specifically income based. It's more loan to value based or loan to GDV based. There aren't very many regulated development finance lenders out there at all. And the reason for that is when it's your home, you're often inexperienced. You often fall in love with it, and the kitchen that you want now is double the price. And the bedroom that you want now has an ensuite. So all these extra costs pop up along the way, which aren't factored in at the outset. And that can be, basically a nightmare for a lender when the funds or the build costs that were pre-agreed and now have been used for something else without permission. And now there's a lack of funds available and they can't finish the build and they end up with a project that's half done and unmortgageable. Not so unmortgageable nowadays because there's a lender for that, but anyway, you get the point. Regulated development becomes emotional and costly, and therefore a lot of lenders just don't get involved in that market. Having said that, there are now a couple of lenders that will offer regulated development finance, and this is going to be based on your end value. So they look at the end value, which is gross development value or GDV. They will factor in the build cost and take that away and see what's left. Now you may own the land already, which may mean that you can get a little bit of money on day one to start your project, or it might be a purchase as well. So whatever the situation, speak to your broker and they will give you terms and how that finance will be worked out for you and the rate, etc. But bear in mind that you do have to repay the loan at the end, and if you're going onto a normal residential mortgage because you're going to live there, it will be based on income. So as a broker will always start with the exit in mind. So your income will come into it because you do have to exit onto a residential regulated mortgage, which is income based. So is your income enough to get you out of this regulated bridge? And that's going to be the first thing your broker is going to be looking at. You might have other options. You might have a property you're going to sell in the background. So yeah, hopefully it would all work out and in your favour, but that's the main difference between the two. Thanks for listening. If you have any questions, please leave them below. If you're watching on YouTube, please like and subscribe. And I'll be back shortly with plenty more videos for you. Thanks for watching. Have a good day. Bye.